Yesterday, after returning from a month-long journey across Asia, I wrote down a single sentence that has stayed in my mind ever since. I did not write it as a prediction, a political statement, or a headline designed to attract attention. I wrote it because it was the unavoidable conclusion reached by nearly every investor, policymaker, entrepreneur, and business leader I met during that trip. The sentence was simple. The world is no longer organizing itself around a single economic center. That may sound abstract, but the financial consequences are anything but abstract. They affect the value of your savings, the performance of your investments, and the opportunities that will define the next decade. During my travels, I sat in meetings with people managing billions of dollars, executives building international supply chains, and decision-makers directing capital across multiple continents. What surprised me was not that they had different opinions. What surprised me was how similar their conclusions were across different countries, cultures, and industries. I kept hearing the same message repeated in different ways. The global economy is entering a new phase, one in which power, influence, and investment flows are becoming more distributed than at any point in recent history. Many Americans still view the world through the lens of the last 30 years, a period when one country dominated global finance, technology, and trade. But outside America, many investors are already preparing for a future that looks very different. They are diversifying relationships, expanding partnerships, and positioning themselves for a world where growth comes from multiple regions rather than single dominant market. What struck me most was the confidence with which these decisions are being made. These are not theoretical discussions taking place in think tanks or academic conferences. They are real-world decisions involving real money, real businesses, and real economic priorities. And when enough influential people begin moving capital in the same direction, markets eventually follow. That is why what I observed during this trip matters. It is not merely an interesting geopolitical trend. It is a shift that could influence the value of assets, currencies, and investment opportunities for years to come. The people I met are already positioning themselves for that future. The question every investor must ask is whether they are paying attention before the rest of the market catches up. To understand why this shift is happening, you first need to understand something that most investors overlook. Major economic changes rarely begin with dramatic announcements. They begin quietly, through thousands of small decisions made by businesses, governments, and institutions. When historians look back at transformational periods, they often identify a single date or event as the turning point. But the people living through those moments rarely recognize them in real time. Instead, they experience a gradual accumulation of signals that only become obvious when viewed together. That is exactly what I observed during my conversations across Asia. In city after city, I encountered evidence of long-term planning on a scale that many Western investors fail to appreciate. New infrastructure projects were being developed. Trade agreements were being expanded, manufacturing capacity was being increased, and investment capital was being directed toward industries expected to define the next generation of economic growth. None of these developments alone would be remarkable, but together they paint a picture of a world preparing for a future that differs significantly from the one most people assume will continue indefinitely. One executive I met explained it in a way that immediately caught my attention. He said that the most important question investors should ask is not which country is winning today, but which countries are building for tomorrow. That distinction matters because financial markets often reward past success long after future growth has begun shifting elsewhere. Investors naturally feel comfortable allocating capital to markets that have performed well for years. The problem is that markets price expectations, not history. By the time a trend becomes obvious to everyone, much of the opportunity has already disappeared. This is why institutional investors spend enormous resources identifying changes before they become widely recognized. They understand that wealth is often created not by following consensus but by recognizing emerging realities before they are fully reflected in asset prices. Throughout my trip, I repeatedly saw signs that many large investors are beginning to think differently about where future growth will originate. They are not abandoning established markets, but they are becoming increasingly interested in regions where economic expansion, demographic trends, technological development, and industrial investment appear stronger than current market valuations suggest. Whether those expectations prove correct remains to be seen. But what matters is that significant amounts of capital are already moving based on those beliefs. And when capital begins moving, opportunities and risks are created simultaneously. Investors who understand these shifts early may benefit. Those who ignore them may eventually discover that the world changed while they were still focused on yesterday's assumptions. There was one particular meeting during my trip that forced me to think much more deeply about where the global economy may be heading over the next decade. I was sitting with a group of investors whose combined assets under management exceeded the GDP of many countries. These were not people reacting to headlines or short-term market fluctuations. Their job is to think years ahead, sometimes decades ahead. During our discussion, I asked a simple question: what is the biggest mistake the average investor is making right now? I expected to hear concerns about inflation, interest rates, government debt, or geopolitical tensions. Instead, nearly everyone around the table gave some version of the same answer. They believe most investors are excessively focused on short-term uncertainty while ignoring long-term structural change. That answer stayed with me because it highlights a recurring pattern. Throughout financial history, human beings are naturally drawn toward immediate events. We pay attention to elections, quarterly earnings reports, central bank announcements, and market volatility because they dominate the news cycle. Yet many of the most important investment opportunities emerge from trends that develop slowly over many years. The rise of the internet, the growth of emerging economies, the expansion of global trade, and the development of artificial intelligence all began long before most investors recognized their significance. By the time these trends became obvious, substantial wealth had already been created. What I observed across Asia suggests that another long-term transition may already be underway. Governments are investing heavily in strategic industries. Businesses are redesigning supply chains. Technology companies are competing aggressively for leadership in fields that barely existed a decade ago. Educational institutions are producing millions of highly skilled graduates who will shape the future workforce. Most importantly, enormous amounts of capital are being directed toward these initiatives with a time horizon measured in decades rather than quarters. This creates an interesting disconnect between perception and reality. Many investors continue evaluating opportunities using frameworks developed for a world that existed 20 years ago. Meanwhile, some of the world's largest institutions are allocating resources based on where they believe growth will exist 20 years from now. The difference between those two perspectives may ultimately determine who benefits most from the next chapter of global economic development. None of this means that established economies will suddenly decline or disappear. History is rarely that simple. What it does mean is that the competitive landscape is evolving faster than many people realize. Investors who understand that evolution may position themselves more effectively than those who assume the future will simply resemble an extension of the past. The most important observation I made during this journey was not something I saw in a boardroom, a government office, or a financial conference. It was something I noticed repeatedly across multiple countries, industries, and conversations. Everywhere I went, people were talking about the future with a level of confidence and long-term optimism that has become increasingly rare in many developed economies. They were not claiming that challenges do not exist. Every country faces economic risks, political disagreements, demographic pressures, and financial uncertainty. What stood out was their willingness to invest despite those challenges. New factories were being built, research centers were expanding, transportation networks were being upgraded, technology startups were attracting capital, businesses were making decisions based on what they believed the world would look like 10 or 20 years from now, rather than focusing exclusively on next quarter's results. This matters because economic growth is ultimately driven by investment. When individuals, companies, and governments believe the future will be better than the present, they invest. They build, innovate, hire, and expand. When confidence disappears, investment slows, and economic momentum eventually weakens. Throughout history, the countries and regions that attracted the greatest investment often became the centers of economic growth. In the decades that followed, what I observed during this trip was not a single country rising or another declining. It was the emergence of a more competitive global landscape. Multiple regions are now competing aggressively for talent, capital, technology, and influence. That competition is reshaping global investment flows in ways that many investors have not fully appreciated. For decades, allocating capital was relatively straightforward. Investors could concentrate heavily in a handful of dominant markets and achieve excellent results. But the world is becoming more complex. Growth opportunities are appearing in places that many investors have historically ignored. Industries that barely existed a generation ago are attracting hundreds of billions of dollars in investment. New technologies are creating entirely new categories of economic activity. As a result, investors may need to think differently about diversification, risk, and opportunity. The future may belong not to a single dominant economy, but to a network of highly competitive regions, each contributing to global growth in different ways. If that happens, portfolios built exclusively around the assumptions of the past could face increasing challenges. The investors who thrive may be those willing to broaden their perspective, study global trends objectively, and position themselves for a world that looks very different from the one that created the last generation of investment winners. And that brings us to the financial implications of everything I witnessed during those 30 days. Now let's talk about the financial implications, because observations are only valuable if they help us make better decisions. During my trip, I kept asking myself a simple question. If the world is becoming more economically distributed, what does that mean for investors over the next decade? The answer is more significant than most people realize. Financial markets are driven by expectations. Prices rise not simply because conditions are good today, but because investors believe conditions will be even better tomorrow. Likewise, prices fall when expectations become too optimistic and reality struggles to keep pace. This is why valuation matters. When investors become extremely confident about a particular market, industry, or asset class, they often push prices far beyond what future growth can justify. At that point, even strong performance may not be enough to produce attractive investment returns. Throughout history, some of the best opportunities have emerged when there was a large gap between perception and reality. Markets that were ignored, misunderstood, or underestimated often generated exceptional returns once investors recognized their true potential. During many of my conversations, I noticed that institutional investors were paying close attention to these valuation gaps. They were not simply chasing the markets that had performed best over the previous decade. Instead, they were looking for areas where long-term growth prospects appeared stronger than current market prices. Suggested that approach requires patience because valuation mismatches can persist for years. However, when they eventually correct, the results can be substantial. Another important point is diversification. Many investors believe diversification reduces returns because it prevents them from concentrating entirely in the strongest performing assets. The reality is that diversification is often what allows investors to survive periods when the future unfolds differently than expected. The world economy is changing rapidly. Technological breakthroughs, demographic shifts, geopolitical developments, and evolving trade relationships are creating uncertainty alongside opportunity. No investor can predict every outcome correctly. The goal is to build a portfolio capable of benefiting from multiple possible futures. That is why some of the most successful investors in history focus less on making perfect predictions and more on creating resilient strategies. What I observed across Asia reinforced this philosophy. They are building flexible portfolios designed to adapt as conditions evolve. They understand that the future will likely surprise everyone in some way. The question is not whether change is coming. The question is whether investors are positioned to benefit from it when it arrives. So, after everything I saw, every conversation I had, and every observation I made during those 30 days across Asia, what is the final conclusion? It is not that one country will replace another overnight. It is not that a financial collapse is imminent, and it is not that investors should panic. My conclusion is much simpler, and in many ways much more important. The world is changing faster than most people realize, and many investors are still positioned for a version of the future that may no longer exist. History teaches us that every major economic era eventually evolves. New technologies emerge, new industries develop, new regions attract investment, new competitors rise. The investors who succeed during these transitions are rarely the ones who predict every detail correctly. They are the ones who recognize that change is happening before it becomes obvious to everyone else. What I witnessed throughout Asia was not fear. It was preparation. Governments preparing for the next phase of economic growth. Businesses preparing for new trade relationships. Investors preparing for a more competitive global economy. And perhaps most importantly, capital preparing to move toward opportunities that many ordinary investors are still ignoring. That observation should not scare you. It should motivate you, because periods of change often create the greatest opportunities for those willing to learn, adapt, and think independently. The biggest financial mistakes in history have often come from assuming that yesterday's winners will automatically remain tomorrow's winners. The biggest successes have often come from recognizing emerging trends before the majority of investors accepted them as reality. As I returned home and reviewed everything I had learned, one thought kept returning to my mind. The next decade may reward flexibility more than certainty. It may reward diversification more than concentration. It may reward global thinking more than local thinking, and it may reward investors who are willing to question assumptions that have gone unchallenged for many years. Nobody knows exactly how the future will unfold. I certainly don't, but I know this. The people managing the largest pools of capital in the world are not waiting for certainty. They are studying trends. They are evaluating risks. They are positioning themselves for multiple possible outcomes, and they are doing it right now. The opportunity available to ordinary investors is not to predict the future perfectly. The opportunity is to recognize that the future is being built today. Pay attention to where investment is flowing. Pay attention to where innovation is accelerating. Pay attention to where talent is gathering, because those forces ultimately shape the markets, industries, and opportunities that define the next generation of wealth creation. The world is entering a new chapter. The question is not whether that chapter is coming,